Number one planning technique we look at is either trying to avoid or at least delay US tax residency. And this will be determined by whether the route someone is going to become a US tax resident. So generally, they'll be coming into the US with a work visa. And this provides more flexibility than, for instance, a EB5 or green card route.
Welcome back to the hot seat. Delighted today to be joined by Michael Lewis from EY Frank Hirth. Welcome, Michael.
Thank you for having me, David. It's great to be here.
So you're well known, Michael, on the circuit in London in the private wealth sector. But for those who've not had the chance to meet you before, it'd be great to hear a little bit about your background and your role at EY Frank Hirth.
Thank you, David. So I'm a private client advisor who looks after individuals with both US and UK tax issues. So I'm dual qualified both in the UK and the US for that purpose. I have 23 years experience, predominantly based within the Big Four, and I'm currently a partner within EY, seconded to their subsidiary, EY Frank Hirth. And EY Frank Hirth is a firm sort of after my own heart, which also specializes in individuals with US connections. So we look after clients who have a connection in the US, be it investments, citizenship, or any sort of tax liability. And where there's a US connection, then EY Frank Hirth can step in to help people navigate the complexities which arise from that.
Okay, thank you. And throughout the pandemic, we've done a lot of content around cross-border connections to the US. You featured in some of our webinars. Relocation, mobility, and cross-border investment were some key themes. As we kind of start to emerge from the COVID pandemic, people are making some changes, including perhaps potential moves to the US. There are many ways in which they can go wrong, and we can just chat today about some of the ways in which they can be best prepared and make sure they don't fall foul of some of these traps. So, Michael, perhaps you could introduce some of the key ideas that people should bear in mind in pre-arrival planning when looking at a move to the US.
Okay, absolutely. So, I mean, just to add to your intro, David, we're also seeing a lot of hybrid working where people are spending substantial amounts of time in America in a way they just wouldn't have done previously. So I've seen clients who might have, ranches and, holiday homes where they're now spending many months of the year because it's easy to do so. So that also triggers potential residence and immigration issues, which they hadn't normally have considered, because it's not the typical move. It's a more kind of, they're going to cross the threshold, so to speak. So that's something else to be very conscious of. It's not just about doing a big move, it's also just maybe spending too much time there. And it's worth noting that the US is still extremely popular destination to be based. It's still a popular location to visit. And of course, it's where many of our clients have significant investments and will want to go and check on them. So it's a very popular location, but definitely not a low tax location. So the first thing you need to understand is the environment. The US is not low tax for high income earners. For medium and low income, actually it's quite generous. It has very generous tax bands, very generous deductions. But if you're a wealthy individual, the top US tax rate is 37%. Plus there's additional Social Security or net investment income taxes on top of that. So that will take you above 40. Plus, depending which state you live, you could also have another 14% tax on top of that. So having tax rates into the 50s is not uncommon. And in fact, the Biden administration was pressing to have a tax rise of up to 8%, an 8% surcharge on the wealthy. So, that narrowly failed by one vote, before the new year. And it's only likely in the short term that taxes are going to rise rather than fall. So that gives some idea of the level of taxes someone might face if they were resident in the US and they were a higher earner. So that's the environment that we're dealing with.
And cross-border clients, they have even more complexity, don't they? Because they might be facing tax in other jurisdictions as well, which I'm sure is where you really create value for people avoiding some.
Absolutely. And it's not just tax as well, David, because the US love their reporting. So if someone, triggers US tax residency, not only do they have to deal with the high taxes I just mentioned, they're going to face a huge amount of reporting, because the US is paranoid about anything which has a foreign element, because they sort of almost perceive that as a potential tax evasion route, and hence they require a huge amount of detailed information to be provided to them. So that's the environment you're dealing with if you get on the wrong side of the US residency, and also means why planning for that eventuality or planning to avoid it is actually very important.
Okay, and what are the steps around the timing of residency if people are planning a bigger move? What and they are making those preparations? How should they approach it?
Well, the number one planning technique we look at is either trying to avoid or at least delay US tax residency. And this will be determined by whether the route someone is going to become US tax resident. So generally, they'll be coming into the US with a work visa. And this provides more flexibility than, for instance, a EB-5 or green card route. And if someone's going into the US with a work visa, then the residence will be determined by reference to the substantial presence test. And this is a test which looks at your days in the US, and it applies a sort of 3-year look back test where you look at the current year, you look at the prior year, you look at the preceding year, and you take all the days in the current year, you take 1/3 of the preceding year, and then 1/6 of the days in the in the preceding year, and you add up all those US days based on that fraction. And if you hit 183, then you fail the test and you're regarded as resident. But if you're under, you're okay. And that generally averages out at 121 days a year. So a rule of thumb is if you never go above 121, you never have to worry about it. That doesn't mean you can't go above 121. It just means that, you could if you were lower in the prior years. So you might have a bit of flexibility whereby you can go up and, you can vary each year slightly. But you have to be careful. And the rule of thumb is this: 121, it's fine.
But good record keeping, I guess, then is essential in order to
absolutely,
map where you are.
And good planning. And also this rule is very helpful as well for someone moving in the second part of the year, because if you move in the second part of the year and you haven't had many days in the US in prior years, it often means that someone can move, let's say in July, August, and with a little bit of careful planning, such as holidays outside of America, they won't trigger residency until the following January, often allowing a period of planning where they can be non-resident anyway. The ultimate, dream for a tax advisor like myself, to have someone where you're not resident anywhere, and therefore we can do a lot of advanced planning. So that's the first item to look to say, can we avoid residency? Can you plan your days to avoid it completely? Or at least can we delay it? And often you can delay it by 6 months or maybe even a year with careful planning, which allows us to do some thinking and structuring for individuals' tax affairs. So that's strategy number one.
Okay, and then what are some of the ideas around realizing gains and income pre-residency? So those who've availed themselves of this forward step, they've looked at the opportunities. What's the thinking behind some of the pre-planning they might do in terms of realizing gains?
Exactly. So as I said, because the US is such a high tax jurisdiction, it will generally make sense to try and realize gains in income before you get there. And this is especially true if you can generate a period of non-residence anywhere where that income and gains won't even be taxed. So you'll look to realize assets, you'll look to realize profits. If, for instance, you've got a bonus with an employer, perhaps you'll request that be paid just before you go to America as opposed to just afterwards. You might think about exercising stock options earlier than becoming resident. But the general rule is, if you've got any kind of choice about when to realize income and profits, you're probably going to realize them before you become US tax resident. But similarly, the inverse is also the case. If you're thinking about deductions, so realizing losses or realize, well, you probably want to delay them to when you're resident. So you then bank them to offset this high US tax rate. So think about what you can control and try and adjust them accordingly. And, on the deduction point, there's also some very interesting planning you can do with sort of charities, whereby effectively you can pick up a deduction in both jurisdictions. So for instance, the UK to the US is great planning. For almost 2 years after you've gone to the US, you might be able to pick up a deduction in the US and in the UK, effectively doubling your tax relief. So there is a lot that we can play both on the one side of advancing income and advancing, gains pre-US residency, but also delaying deductions and delaying losses until US residency.
And what are some of the most sort of troublesome assets from a US perspective? You're reviewing someone's personal balance sheet. What is it that are setting off alarm bells in that?
Well, I hinted it before that the US love their reporting. And there's certain assets which both have significant reporting obligations, but also potentially adverse tax consequences. So the two that we come across most often are what's known as the passive foreign investment companies, otherwise known as PFICs. And this is basically investments in companies which have predominantly passive income. And a huge example of this would be non-US mutual funds. So this would be UK unit trusts, UK OICs, etc. And, so many people have those kind of investments, and they'll move to America, nothing of it. But not only is there some really adverse reporting for those investments, the tax actually can be horrendous. Because on those types of assets, the US, firstly, by default, taxes all gains as income. But worse, it imposes a sort of surtax based on how long you've held the investment. And this surtax is compounded such that it can actually reach 100%. In fact, the US, caps the tax rate at 100% because mathematically it can go higher. Now, this means these investments are incredibly expensive to have. So they're absolutely those investments that you'd want to look to maybe dispose of before you went there, or at least rebase. And we didn't really touch upon rebasing, before, but the US does have some, there is planning you can do on moving to the States where you can rebase assets by basically bed and breakfast and selling them and buying them back. And that, as a minimum, you should probably look to do that with PFIC investments. The other main type of investment we see, which causes problems, is significant shareholdings in companies. So if a company is controlled by US people, it will be subject to the US controlled foreign corporation tax rules, which effectively applies a sort of look-through rule which says that actually certain income is deemed distributed as if it was a dividend. And this can also impose some adverse tax implications. And of course, if you've got a 51% shareholding of a company and you move to America and become a US person, well, by definition, that company becomes controlled by US people. And you need to take into account not just your interests, but interests of your spouse and connected persons as well. So that's the other key issue. Are you going to create a controlled foreign corporation by moving to the States? And those are probably the sort of two that we see the most, right?
Okay, and on the wealth structuring side, I mean, what are some of the options for if people have accumulated savings while resident in the UK or elsewhere? They might avail themselves of different options. What is it that they might look at before a move to the States?
Well, I mean, we talked about this, the bed and breakfast thing, the rebasing of assets, and often that can be done in a way which doesn't trigger local tax. So either by having a period of non-residence anywhere, or indeed by the fact that the UK has a 30-day rule on securities. such that you match your acquisitions with sales in the next 30 days. So you actually have a way of disposing and rebasing for US tax purposes, which doesn't trigger, for instance, UK tax if the move is from the UK to the US. So that's probably technique number one. There's other assets which are not sort of liquid and more complicated. But there are methods of rebasing, particularly on assets which are held in vehicles such as partnerships and companies through special elections known as check the box elections, which is probably a little bit more sophisticated than we have time for to go into today. But other than to know there is planning available out there. And a lot of planning we do looks to unwind structures such that we get out of the PFIC rules, or we get out of the CFC rules. And those are sort of the typical planning that you look to do. Now, if you're looking to be more sophisticated, there are other products out there you could consider, such as insurance wrappers, whereby you can hold investments within this wrapper and they can grow free of tax. And the idea being here is that you would then look to come out of that product only after you've left the US. So it's sort of like an investment, sort of compulsory saving vehicle while you go to America. Now, the good thing about it is, as I said, there's no US tax as you go along. And you can invest in assets such as PFICs, which you couldn't ordinarily have invested through, albeit you're investing indirectly via the insurance company. But there are catches with this. Obviously, fees is a significant catch, as is the fact that it's not your money, it's the insurance company's money. And that means that you can't control the money. It has to be managed on a discretionary basis. So it doesn't suit everybody because of the fees. It doesn't suit anyone because of the lack of control.
Okay, thanks. And what about on the trust planning side? A huge amount of complexity there, matching up different jurisdictional rules around trust and wealth structure.
Well, I didn't really touch upon that as a troublesome asset, but trusts are hugely complicated. And so one of the things we would always look at is whether someone is a beneficiary of a trust or a settler of a trust, or indeed has any sort of trust interest. Because once again, starting position is, if you are, this is going to trigger significant reporting, but also it's going to trigger potentially significant tax. Because if you are a beneficiary of a non-US trust, it's likely that you're going to be subject to adverse tax in a way very similar to the way I described the PFIC rules working, that trust distributions are taxed as income with a potential surtax based on how long the income has been retained within the trust. Once again, with tax rates potentially going up to 100%. So quite a adverse, position to be in. So for planning purposes, for beneficiaries, you might be saying, take distributions out of a trust pre-US residency, and then don't take anything for the time you're in there. Or we might look to, for a settler of a trust who has some control of that trust, we might look to restructure that trust into a way which is more tax efficient for someone going into the States. So there's lots of planning that needs to be done, but it's absolutely essential that someone's moving to America with trust interests, that they take advice, and those trusts are reviewed beforehand, because the US tax rules on trust taxation are extremely complex.
Thanks for that. And I mean, what are you seeing more generally as well about specific areas that are most popular for relocation? I mean, I speak to people often in Miami who say Miami is booming in a variety of sectors. There's been a lot of inbound.
Miami is booming. I mean, it does depend. So we're seeing a lot of people who are, historically New York based, moving to, Florida. And there's lots of reason for that. It's obviously the fact that Florida doesn't have a state income tax, but also it doesn't have a state estate tax as well. So for someone thinking about, future planning in terms of wealth, the next generation, definitely makes sense to move to Florida. Of course, the clients that we typically see and typically deal with are clients who are more often in their sort of earning space of, you know, business owners, entrepreneurs, etc. And of course, that means that those locations most attracted to them are generally California and New York, or, you know, in the, you know, New York and surrounding tri-state area. The problem with that is, of course, those are all the states which have very high tax rates. So yes, we are seeing, you know, trend for people, for other states to be interested, particularly in hybrid working. So people are looking at, you know, Wyoming and other places like that, where they might have their holiday homes, but still an awful lot of clients are looking to be predominantly based in California or New York.
Thank you, Michael. It's been great to talk to you today, and we look forward to sharing this with our members.